You felt it, didn't you? That distinct, sickening drop in your stomach when you checked the charts on Friday morning. It wasn't just a red candle, it was a physical blow. Silver, the asset we have pinned our hopes on, the metal of the future, the shield against inflation, just got punched in the mouth, hard. It didn't just slide, it plummeted into an air pocket, a vacuum of liquidity that left seasoned traders gasping for air and newcomers wondering if they had made a catastrophic mistake. If you are watching this, you are likely sitting in the aftermath of that violence, looking at the wreckage of the last 48 hours and asking yourself the question that screams in the silence of a crashing market. Was I wrong? Is the thesis dead? Did I just bet my future on a losing horse? I am here to tell you that what you are feeling is not the pain of a mistake, but the pain of a stress test. You have just survived a financial stress test designed by the very system that is currently crumbling under the weight of its own debt. This was not a fundamental rejection of silver. It was a mechanical purge. It was a calculated shakeout. And the way you interpret this specific moment in time, Friday, February 6th, 2026, will determine whether you end up as a victim of this wealth transfer or a victor. Because while the price on the screen says one thing, the reality of the global economy screams another. We are living through the most extreme global debt binge in recorded history, a mathematical singularity that guarantees the destruction of fiat currency. And in that destruction, silver is not just going to $100. It is on a trajectory to $500 and beyond, not because of hype, but because of necessity. We need to dissect the anatomy of this crash because understanding the mechanism of your pain is the first step to conquering it. What we witnessed was not a rational market adjusting its expectations. It was a cocktail of leverage, liquidity, and algorithmic violence. When the market opened, silver was already sitting on a precarious ledge. It had run up too fast, fueled by tourists and speculators who didn't understand the long-term thesis. These tourists were trading on margin. They were borrowing money to bet on the price going up. And margin is a double-edged sword. It amplifies your gains, but it exposes your throat to the knife of volatility. The catalyst could have been anything. A headline about the dollar, a rumor about interest rates, a sneeze from a central banker. It doesn't matter what the spark was. What matters is the fuel. The fuel was the leverage. When the price ticked down, the first wave of margin calls went out. The exchanges, acting with the cold logic of a machine, demanded more cash from the traders. The traders, overextended and panicked, didn't have the cash. So the exchanges sold their positions. This forced selling drove the price down further, triggering the next wave of margin calls, and the next, and the next. It was a cascade, a waterfall of liquidation. In moments like that, the price of silver has nothing to do with supply and demand. It has nothing to do with solar panels or missiles. It has everything to do with liquidity. The price goes to wherever it needs to go to find a buyer, and on Friday the buyers stepped back and let the sellers fall into the abyss. But here is the crucial distinction you must make if you want to survive this bull market. You must distinguish between a broken price and a broken thesis. The price of silver broke on Friday. The thesis for silver did not. In fact, the thesis got stronger. While the paper price was collapsing, the debt that necessitates higher silver prices was still growing. The global debt pile has now reached levels that are frankly terrifying. We are looking at over $251 trillion of global debt. That is 251 trillion reasons why the current monetary system cannot survive. Think about that number. It is an abstraction to most people, a number so large it loses its meaning. But let's make it concrete. That debt represents a claim on future labor, future energy, and future production that can never be paid back. It is a lie written on a balance sheet. The world economy is carrying a debt load that is more than 235% of global GDP. We are drowning in promises we cannot keep. And when a government or a civilization makes promises it cannot keep, it has only two choices: default or inflate. A default would mean a collapse of the banking system, a depression that would make the 1930s look like a picnic, and social chaos. No politician, no central banker, no leader will ever choose that option voluntarily. They will choose the second option. They will choose to print. They will choose to inflate. They will choose to devalue the currency until the debt becomes manageable in nominal terms. This is the debt binge that is the engine of our thesis. We are in the terminal phase of a debt supercycle. In this phase, volatility increases. The system becomes unstable. The central banks lose control. They try to talk tough. They try to raise rates. They try to manage the yield curve. But the math is against them. You cannot raise rates on $251 trillion of debt without blowing up the budget. You cannot keep the system liquid without printing more money. It is a trap. And the only escape from that trap for the individual investor is to hold assets that cannot be printed, assets that have no counterparty risk, assets that are real. This brings us to the $500 silver target. To many, $500 sounds like a fantasy. It sounds like internet hype. But if you do the math of the debt, if you adjust for the expansion of the money supply, if you look at the historical ratios of gold to silver, $500 is not a ceiling. It is a rational valuation. In a world where gold goes to $10,000 or $20,000, which is where it must go to backstop the global financial system, silver at a 40-to-1 ratio puts us at $500. It is not magic. It is repricing. It is the currency catching up to the reality of its own worthlessness. But the path to $500 is not a straight line. It is a jagged, violent, nauseating road filled with traps and ambushes. Friday was one of those ambushes. The market makers, the bullion banks, the entities that control the paper flow, they know this reset is coming. They know the price has to go higher, but they don't want you on the ride. They want to buck you off. They want to steal your position. They want you to sell in a panic at $75 so they can sell it back to you at $300. This volatility is a weapon. It is psychological warfare designed to separate the weak hands from the strong hands. So how do we navigate this storm? How do we keep our sanity when the charts look like a crime scene? We need a strategy that is built for chaos. We need to stop thinking like gamblers and start thinking like risk managers. The first step is to categorize your holdings. You cannot treat your entire portfolio as one monolithic block. You need buckets. Bucket number one is your insurance. This is your physical metal. This is the silver you hold in your hand, in your safe, in your possession. This silver is not for trading. It is not for speculation. It is for survival. It is the portion of your wealth that you have taken off the grid, out of the system, You do not sell this silver because the price dropped on a Friday. You do not care about the spot price. The spot price is a fiction created by the paper market. Your insurance is real. You hold it because you know that in a debt collapse, counterparty risk is fatal. If you hold a paper contract, you are relying on someone else to pay you. If you hold physical silver, you are reliant on no one. This bucket allows you to sleep at night. Bucket number 2 is your ratio play. This is the silver you hold with the specific intention of swapping it for other assets later. We know that asset classes move in cycles. Right now, silver is undervalued relative to real estate, relative to stocks, relative to land. But there will come a time, perhaps when silver hits that $500 mark, when it will be overvalued. At that moment, you trade your silver for a rental property, for a farm, for a dividend-paying business. You use the volatility of silver to slingshot yourself into cash-flowing assets. This bucket requires patience, but it also requires a plan. You need to know your exit strategy before you get to the exit. Bucket number 3 is your tactical speculation. This is the paper silver, the ETFs, the mining stocks. This is the bucket where you are allowed to be wrong. This is the bucket where you use stops. This is the bucket where you trade the volatility rather than suffering from it. If you tried to trade Friday's crash with your insurance bucket, you would be emotionally devastated. But if you traded it with your tactical bucket, it was just a bad day at the office. You cut your loss, you regroup, and you wait for the next setup. Separating these buckets in your mind is the key to emotional resilience. Now let's talk about the recovery. After a crash like Friday, the market leaves clues. We need to be detectives. There are 3 scenarios that typically play out after a liquidation event. Scenario A is the dead cat bounce. The price pops up, everyone breathes a sigh of relief, the pundits declare the bottom is in, and then the price rolls over and makes a new low. This is the market's favorite torture device. It gives you hope just to crush it again. Scenario B is the grind. The price stops falling, but it doesn't go up. It chops sideways. It bores you to death. It frustrates both the bulls and the bears. Scenario C is the V-shape reversal. The selling exhausts itself, the forced sellers are gone, and the price rips back up to the highs in a face-ripping rally. Which one are we in? The probabilities favor the grind or the dead cat bounce? The damage done on Friday was structural. It broke charts. It broke confidence. It takes time to repair that. Do not expect a straight line back to the highs immediately. Expect volatility. Expect confusion. Expect the market to test your resolve again. The key is to watch how the price reacts to bad news. If we get a negative headline, a strong dollar print, a hawkish Fed speech, and the price of silver refuses to go down, that is your signal. That is the market telling you that the sellers are done. That is the bottom. We must also look at the miners. The mining stocks are the leverage on the metal. They are supposed to outperform silver on the way up, but recently they have lagged. They have disappointed. Why? Because mining is a business, not a rock. Miners have input costs. They consume energy. Diesel, electricity, explosives, these are the costs of extraction. And energy prices have been stubborn. When energy is high and metal is volatile, margins get squeezed. The market punishes uncertainty, but this creates an opportunity. If you believe in the $500 silver thesis, then the miners at these levels are historically cheap. They are priced for bankruptcy in a world that is preparing for a commodity supercycle. But be careful. Not all miners are created equal. In a debt crisis, capital becomes expensive. The junior miners, the explorers with no revenue and no cash flow, are risky. They rely on issuing shares to keep the lights on. If the stock market crashes, their funding dries up. They go to zero. The mid-tier producers, the companies that are actually pulling metal out of the ground and generating free cash flow, are the sweet spot. They have the resilience to survive the crash and the leverage to explode in the recovery. Do not treat the mining sector as a monolith. Be selective. Be ruthless. Quality matters more than hype. Let's pivot to the forgotten trades. While everyone is obsessing over the carnage in silver, there are other markets that are signaling the same debt crisis but receiving none of the attention. Look at uranium. Uranium is the ultimate supply-demand mismatch. The world is realizing that green energy fantasies cannot power an AI civilization. We need baseload power. We need nuclear. The demand for uranium is structural and growing, while the supply has been decimated by a decade of underinvestment. Uranium is not a day trade. It is a slow squeeze. It is a market where the price is negotiated in back rooms, not flashed on high-frequency screens. It is the quiet bull market that will likely outlast the noise in silver. And then there is platinum, the unloved metal. Platinum has been ignored for years. It is cheaper than gold, cheaper than palladium, sometimes cheaper than the cost of production. But platinum is essential for the hydrogen economy. It is essential for catalytic converters. It is a monetary metal with a history of trading at a premium to gold. If we are entering a period of hard asset repricing, platinum is the catch-up trade. It is the coiled spring that nobody is watching. Diversification into these assets is not a distraction. It is a way to hedge your bets within the hard asset theme. But let's return to the core message: the debt. The $25 trillion elephant in the room. Why does this inevitably lead to $500 silver? Because the only way to service this debt is to debase the denominator. The government must make the dollar worth less so that the debt is easier to pay back. This is financial repression. It is the policy of keeping interest rates below the rate of inflation. It is a tax on savers. It is a transfer of wealth from the prudent to the profligate. In a regime of financial repression, real assets must rise in nominal terms. If the government prints 20% more money, the price of silver should rise by 20% just to stay even. But silver has a multiplier effect because it is a tiny market, because it is essential for industry, and because it is a monetary safe haven. A small amount of money fleeing the bond market creates a massive move in the silver price. The bond market is an ocean. The silver market is a shot glass. If a whale moves in the ocean, a tsunami hits the shot glass. We are watching the bond vigilantes wake up. The yields on sovereign debt are rising not because the economy is strong, but because the creditors are getting nervous. They are starting to demand a risk premium for lending to a bankrupt government. This is the death spiral. Higher yields mean higher interest payments, which means more deficit spending, which means more borrowing, which leads to even higher yields. The only circuit breaker is the central bank printing press. They will have to implement yield curve control. They will have to cap rates. And when they do, when they officially announce that they will print infinity to save the bond market, that is the moment silver goes vertical. That is the moment the $500 target becomes a reality. Friday's crash was a tremor. It was a warning shot, but it was not the earthquake. The earthquake is the sovereign debt crisis. And when that earthquake hits, you do not want to be holding paper promises. You want to be holding the thing that has survived every empire collapse in history. You want to be holding silver. The psychological toll of this volatility is real. It is designed to wear you down. The basing grind, scenario B, is perhaps the hardest to endure. It is the Chinese water torture of investing. Drip, drip, drip. The price does nothing. It goes sideways. It bores you. You start to doubt. You start to look at other assets. Look at the tech stocks, you say. They are going up. Why am I stuck in this dead rock? This boredom is a weapon. The market wants you to sell your position out of boredom right before the move happens. The smart money accumulates during the grind. They buy when it is quiet. They buy when the tourists have left. You must adopt the mindset of a resident, not a tourist. A tourist complains about the weather. A resident prepares for it. A tourist leaves when things get tough. A resident hunkers down. You are a resident of the silver market. You understand the seasons. You know that after the storm comes the harvest. You do not let a Friday flush shake you out of a generational position. You use the flush. You buy the blood. Remember the 3 buckets. If you are feeling panic right now, it is because your buckets are unbalanced. You have too much in speculation and not enough in insurance. Or you are treating your insurance like speculation. Rebalance your mind. Look at your physical stack. Did the number of ounces change on Friday? No. Did the weight of the bar in your hand change? No. Did the industrial utility of silver disappear? No. Did the national debt go down? No. The reality is unchanged. Only the perception changed. And perception is fleeting. Reality is persistent. The rip your face off scenario, scenario C, is still on the table, though less likely in the immediate short term. But when it happens, it will happen fast. Forced selling creates a vacuum. Once the sellers are gone, the price can ascend rapidly because there is no resistance. The order book is thin. We could wake up one morning to silver up $5, then $10. And the people who sold on Friday will be chasing it, buying back in at higher prices, fueling the rally. Do not be the person who sold the bottom. There is a final aspect to this debt binge that we must address: social stability. High inflation and debt crises lead to social unrest. We are seeing it around the world. Farmers protesting, strikes, political polarization. In times of social unrest, capital seeks safety. It seeks anonymity. Silver is portable, private, and universally recognized wealth. It is the currency of the free man. As the government tries to tighten its grip with CBDCs, central bank digital currencies, and surveillance finance, the premium on privacy will skyrocket. Silver is not just an investment, it is freedom. It is the ability to transact without permission. This value proposition is priceless. The road to $500 is paved with volatility. It is paved with days like Friday. It is paved with doubt. But the destination is assured by the laws of mathematics. You cannot print wealth. You can only print claims on wealth. Eventually, the claims exceed the wealth, and the system resets. We are in the reset. So, take a deep breath. Turn off the charts for the weekend. Look at the big picture. $251 trillion of debt, a shrinking supply of silver, a world on fire. The thesis is not dead. It is just getting started. Do not let the bankers steal your position. Do not let the algorithms scare you out. Stand your ground, hold your mettle, And remember why you started. You started because you saw the truth. A red candle on a Friday doesn't change the truth. It just tests your ability to handle it. The most extreme global debt binge in history is not slowing down. It is accelerating. And as long as it accelerates, silver is the most asymmetrical bet in the financial world. The volatility is the price you pay for the asymmetry. Pay the price. Take the ride. And I will see you on the other side of the reset. This is the moment where fortunes are made and lost, not by the movement of the price, but by the movement of your mind. Stay strong, stay disciplined, and keep stacking. The future belongs to those who hold what is real